Good to have you back. Thank you for joining us. I guess this year we've seen it all. Euphoric start, then fear, then a reminder that equities could be volatile. Just when they turned volatile, they've managed to bounce back. What is in store in the second half now?
Good morning, Nikunj. Well, it's been an interesting year, but whatever is happening, I can't say is unexpected because, quite simply put, we had two great years leading up to what 2022 is all about, and this correction was more or less expected in the cycle. So that's what we've got, and we're trading fairly where we left off at the beginning of the year. So that's how I think the market will move over the next couple of quarters. I mean, the data points are quite simple. They are very macro linked. And there is inflation, and now we're getting 6 months to 9 months of deflationary pressures, and we'll have to see how the central banks globally address all of what's happening out there. So so that's essentially what's happening.
Kenneth, where are you picking your spots now? Is it time to align with very simple commodity consumers? That entire cycle in commodity producers, energy, oil, that's behind us?
The peak is behind us for sure, but I mean, our portfolios or our thought process is consistent. Is now more geared to a kind of I won't call it an inflationary cycle, a cycle where prices of commodities will remain elevated. Prices of commodities will remain elevated because we are not going back to the previous near normal. Okay, the previous near normal when you had large exporting countries across the world that were effectively exporting deflation. Uh, that's come to an end. You've got new trade norms that are there, and within those entire trade norms, prices of everything that were deflationary for almost about a decade will have some kind of pricing power going into the remainder part of this remainder part of 2020, 2020s to 30.
Kenneth, so you always believe in buying stocks which either are in a linear cycle or stocks where there is stress. Let's identify these two pockets. One where you think that irrespective of the macros or the global positioning, there is a compounding linear cycle at play. And where do you think there is stress where you are treasure hunting, moving some rocks, and you're identifying some bargains?
Okay, quite clearly, one place that doesn't favor us in terms of valuations, but sees enormous amount of visibility as far as the macro environment is concerned is tech or IT services. I mean, despite whatever is happening across the world, I think everyone's capital expenditure on IT and IT services is going to expand. And that growth could sustain the IT services for an extremely long period of time. Now, if you look at IT services and you look at the derivatives of all of everything that comes out of IT services, and this will be linked to the domestic cycle, is this industry would be one of the largest employment creators with an inflationary wage bill. Okay, so the top five companies by the end of 2022 cumulatively will employ more than 200,000 people, right? And all of this is coming at inflationary wages. So the discretionary cycle that we are looking at, discretionary spend cycle linked to this industry and what incomes it generates from this is very robust. But I'm a little cautious as far as where some of these companies' valuations are traded. The second extreme of this is also a company which is linked into I would say, the global economic cycle, but has got a very large international footprint, which is pharmaceuticals. So, except for COVID, that 2 year period, this industry has been on a down cycle for almost, I would say, 7 years now. 2015 when it's at its peak, but it's been on a down cycle for almost 7 years, and it's been fairly consolidated. So most of the Indian companies, or I should say all the Indian companies in pharmaceuticals, have very, very robust balance sheets, and 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 their product portfolios are significantly higher or larger than 2015. Um, the only challenge with them is that they are working in an environment wherein there's enormous amount of pricing pressure on the end product. So they're not getting too much of pricing power as far as those companies are concerned. But despite that, I think you're getting them at valuations which are significantly better than 2015 or any time in the last 5 years. So those are two extremes of businesses. One is linearly doing extremely well, which is IT, and pharmaceuticals, which is not doing very well, offers I would now say enormous amount of value still, and still has a macro opportunity which is significantly larger than when we left off than the previous peak.
Good morning, Kenneth. So you've spoken about IT. You told us about pharma, which is still not doing so well. You're saying there will be a new normal now in this bull run. What about banks? With FII staging a comeback, one of the reasons financials and banks had also been so battered was because of the FII sell-off. But since that's changing, and with NPAs being at historical lows, and with the capex cycle turnaround, isn't that a big opportunity?
So banks are going through a valuation cycle. So you're getting them at a price point which is significantly cheaper than what you've ever seen them for some time. Okay, and that's something which is attractive, at least for the next for a couple of years, or should I say at least for the next 1 year. So there's a trade out there. Structurally. We'll have to wait and see how the environment actually plays out. So when you look at this industry, it's down to probably 5, maybe 6 banks that are there, right? Out of 34 odd listed or 30 odd listed banks that are there in the marketplace. You're down to about 6 banks that can be a part of your long-term portfolio. That's the way we see it. Now that's not really participating in a sector that's going more stock picking within that industry. So you can pick and choose which one you're comfortable with. But like you said, this time around, I think balance sheet growth will be led by a capex cycle, and a capex cycle or an inflationary cycle. Now, why are these two interlinked with each other? Right? Because so when you go through a capex cycle or when you go through a commodity cycle, the asset price on the ground actually increases, right? So if you're buying, so if you're putting up a plant or a steel plant today, it will cost you close to about 7.5 to 8,000 crores per million tons, right? That's the new normal cost.
Right. So when we talk about all of this as well, Kenneth, what we saw in January was what? Euphoria, which turned to absolute fear in June. And now, starting to see euphoria again, right? We're 4% away from an all-time high. Broader markets still have to play catch-up. So for the benefit of viewers, can I ask you that of late, when the valuations were much lower, what kind of big changes you made to your portfolio, if any? What did you add, for example?
Actually, nothing. We haven't done some significant changes to the portfolio. We are still fairly, should I say, commodity, capex, and export-oriented linked. What is participating from year to date has been all the domestic revival that has come through, and it's been a deflationary trade, so as to say. So whatever didn't do well over the last 2 years has actually started doing well over the last 6 months. So you take the auto cycle, you take the FMCG business, and you take banks. They are the 3 ones that have led the cycle in this round. The ones that didn't do well were obviously IT. Pharma still continues to drag. Commodities is reasonably weak at this point in time. So that's the 2 changes that are there. We still tend to believe that our portfolios are still very much positioned on the capex, manufacturing, export-oriented part of the entire economy. We have relatively low exposure to the consumer trade and to financials, to lending businesses, I would say, not financials.
Right. Kenneth, great to have you on the show. Thanks as always for taking the time out. And guess what? We're back at 60,000 for the